All right, let's just dive right into this explainer and unpack the massive story that's basically holding up the entire US stock market right now. You see, the value of index funds, retirement accounts, and really the broader market as a whole is currently tied to this single dominant narrative about artificial intelligence. But what happens if the data is actually telling us that this story might be coming to an end?
So, is the biggest tech bubble in history about to burst? Now, before we all just assume AI is going to guarantee endless profits for everyone, we really need to step back and ask if the writing is already on the wall for a massive market correction. Analysts are already drawing some heavy comparisons between today's environment and the famous dot-com bubble. But to truly grasp the sheer scale of what we are looking at here, we have to dig into the numbers and look at the underlying business models driving this total frenzy. Part 1. The trillion-dollar AI myth. Right now, the overarching market narrative is basically insisting that American tech giants are going to make trillions of dollars in profit literally forever, forcing the rest of the world to rely exclusively on their specific technology. It's a story driven by this idea that big tech, since they lack a new hyper-growth product like, say, the next iPhone or a brand new Google search, has just funneled all its resources into AI, treating it as the ultimate silver bullet. But when you actually look at the scale of this AI infrastructure build-out absolutely dwarfs the dot-com bubble by multiples. Even when you adjust it as a percentage of the entire US economy, the sheer volume of money pouring into data centers and microchips right now is completely unprecedented. It is an astronomical bet on one single technology. Which brings us to Section 2, the enterprise trust problem. We have to ask, do businesses actually trust and want this technology in its current form? Because for all the hype floating around, there's a growing hesitation among the actual corporations who are expected to buy and use these massive AI systems. To understand why they're hesitating, let's look at how AI is actually sold. So, the token is the basic pricing unit of AI. You pay for every single word the AI reads or writes, completely regardless of whether the output is actually useful to you or just a made-up hallucination. If AI was truly a guaranteed moneymaker out of the box, AI companies would probably just take a cut of the massive profits they generate for your business. But instead, they charge you for every single token. The financial risk is placed entirely on the buyer, meaning you pay full price even when the product gets it completely wrong. And that massive financial risk completely explains the frustration that is just bubbling up right now across corporate America. As Palantir CEO Alex Karp pointedly put it, I am paying for tokens that create no value. These people are stealing the weights and alpha of my business. Corporate leaders are frankly livid. They realize they risk feeding their closely guarded trade secrets, their special sauce, or their alpha, directly into these open models, which effectively means they are paying to train their future competitors. And we're seeing these fears trigger real-world consequences right now. Countries like France, Germany, and Spain, they're literally walking away from some of these massive contracts. The profound fear of intellectual property theft, combined with totally unmeasurable ROI for what are often $50 million investments, is driving businesses toward a completely different model. We've seen real-world examples, like when Anthropic used the design company Figma's data to launch a competing design product. That was a massive wake-up call for the industry. So now there is a serious, growing push for sovereign AI. Businesses are deciding they just want to download their own models, own their own GPUs, and keep their data completely private and locked down.
Let's move on to Section 3, a broken business model. Even if enterprise trust wasn't an issue at all, the underlying economics of the AI industry, they're fundamentally broken compared to what tech investors are used to. Generative AI is actively breaking the golden rule of tech. Think about it. Traditional software is arguably the greatest business model ever invented. You build the software once, and then adding 1 million new customers is essentially free profit with zero marginal cost. But generative AI, the costs increase linearly. Every single time you hit enter on a prompt, it actively burns electricity and wears down physical hardware. So you have to think of generative AI less like traditional software and way more like a massive restaurant that is actually losing money on every single dish it serves, but is somehow hoping to make it up just by serving a whole lot more food. To put a real number on that metaphorical restaurant bill, $20.9 billion. Seriously, that staggering number is OpenAI's audited cash burn for just the year 2025 alone. And unlike Amazon's early days, where extreme patience from investors was eventually rewarded with much better margins at scale, AI margins are actually getting worse over time. This is simply because every new, smarter model costs exponentially more to run than the previous generation. And this broken model is throwing up massive red flags all over big tech spending. I mean, Oracle is currently building 7.1 gigawatts of capacity. To put that into perspective, that is the power equivalent of several nuclear power plants, and they're doing it for one single money-losing customer. Then you have NVIDIA, who is reportedly lending money to smaller cloud companies who then use that borrowed money to buy NVIDIA's chips, and then NVIDIA turns right around and rents those exact same chips back from them. On top of all that, tech giants like Microsoft, Google, and Meta aren't even disclosing their specific AI revenues. They're deliberately hiding them inside their broader cloud and ad numbers. When an industry leader like NVIDIA is basically funding its own customers to buy its equipment, it's a massive red flag that there just isn't enough real organic demand to justify the crazy spending.
All right, Section 4, the China AI threat.
All of this massive U.S. spending rests on one gigantic assumption: that the U.S. will maintain a permanent monopoly on AI, allowing them to force the rest of the world to pay premium prices forever. But just look at this data. The U.S. is outspending China nearly 10 to 1 right now, representing about 3% of the entire U.S. economy at $764 billion. China, on the other hand, is spending just $102 billion. But as we are about to see, winning the spending race absolutely does not mean you're going to win the customer. So how is China bridging that massive financial gap? It's through a fascinating technique called distillation. This is basically a brilliant shortcut where you train a much cheaper, smaller AI model by simply having it study and compress the answers generated from an expensive frontier model. So China is essentially copying the trillion-dollar homework of the US for an absolute fraction of the cost, and then they're just open sourcing it for anyone in the world to download for free. And the result for the end user is honestly dramatic. For the exact same coding task that took about 5.5 minutes to run, a Chinese open model was 7.5 times cheaper than a top-tier American model. Sure, the US might have the absolute smartest frontier models in the world right now, but let's be real, most businesses just need an AI to do boring everyday tasks, like answering routine customer service emails. For 90% of real-world business use cases, the cheaper option is going to win every single time. And get this, it's not just specialized, heavily funded, state-backed AI labs pulling this off. Take a look at Longcat. This is an AI built by Meituan, which is literally a Chinese food delivery app. And this model is going toe-to-toe with Google's Gemini on several critical performance benchmarks. Think about that. If a food delivery app can match a trillion-dollar US tech giant's heavily funded AI, there is no way you can possibly make back $1 trillion selling what your competitors are just giving away for 90% of the quality at 10% of the price. Which naturally brings us to Section 5. When will the bubble pop? So if the business model is inherently flawed and overseas competition is incredibly fierce and incredibly cheap, what is the actual catalyst that brings this whole house of cards down? Well, history shows us that the market narrative usually changes long before the tech companies actually stop laying the cables and building out the data centers. Looking back at the dot-com precedent, the Nasdaq hit its absolute peak in March of 2000. Yet, telecom companies kept spending billions of dollars, laying fiber optic cable well into mid-2001. The physical infrastructure spending didn't actually collapse until late 2001. The market stopped believing the story a full year before the companies actually stopped spending their cash. The pop itself probably isn't going to be some dramatic overnight crash. Actually, it'll likely be a super boring, routine earnings call where a single CEO just casually announces they are, quote, moderating infrastructure investment. Analysts are already noting that the very first tech giant to explicitly cut their AI capital expenditures will likely be instantly rewarded by Wall Street for acting responsibly. And once that happens, it's going to give every other CEO in this highly copycat industry immediate permission to do the exact same thing, triggering a massive domino effect of spending cuts. There's also another early warning sign quietly hiding right now in the debt markets. It's something called the credit spread. Basically, this is the extra interest premium that companies have to pay over the government's risk-free rate to compensate lenders for the risk of the company going bankrupt. The bond market is often called the true fear gauge of the entire economy. When lenders inevitably start getting scared that the trillions of dollars tied up in AI data center debt won't be repaid, these spreads are going to violently explode. But right now, credit spreads are sitting at a historically calm 2.6%. The market feels perfectly safe. But, and this is a big but, That is exactly where they were in early 2007, right before the global financial crash. Lenders feel incredibly safe right now? Sure, but remember, the credit markets were completely calm right before the 2008 housing crisis, too. These metrics measure what lenders currently believe in this exact moment, not necessarily the underlying systemic reality of the actual risk. And we're already seeing some pretty deep shifts in market behavior just beneath the surface. Take the warning signs from Michael Burry, the investor who famously predicted the 2008 crash. He points out three really distinct things happening right now. First, chip stocks are trading at 15-year valuation peaks. Second, the hyperscalers, meaning the tech giants who are actually spending all the money building the AI, are seeing almost zero stock growth compared to the companies just selling them the chips. And third, the LLM token expenditure index, which tracks the average price people are actually paying for AI usage, is down 20% since May. That indicates that real business demand is actively shifting toward those cheaper models we talked about. Wall Street is currently rewarding the companies selling the shovels, but is absolutely refusing to reward the tech giants actually doing all the trillion-dollar digging. So, this all leaves us with one final, absolutely critical question. We're watching the single most expensive infrastructure build-out in human history, all built on a story of endless monopolistic profits. But with broken profit margins, deep enterprise distrust, and open-source competitors doing it for a fraction of the cost, will Wall Street notice the warning signs before the massive spending suddenly grinds to a halt? And more importantly, who exactly is going to be left holding the bag when the music finally stops?